Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We're here to dive deep into the latest market movements, economic data, and policy shifts shaping our world right now. Today, we're unpacking a fascinating stack of recent reports from top financial publications like CNBC, Bloomberg, Reuters, CNN, and Yahoo Finance, giving you the insider's shortcut to understanding what's truly moving the needle. Our mission today is to distill the most important insights from these headlines, helping you connect the dots, between global markets, evolving trade policies, central bank actions, and the cutting edge of technology.
Indeed, it's been a truly dynamic period, really setting the stage for what promises to be a very interesting second half of the year. What's often fascinating, and what we'll explore today, is how interconnected these seemingly disparate elements truly are. A shift in trade policy on one continent can reverberate through stock markets globally and even, influence central bank decisions. It's all linked.
Okay, let's unpack this then. We'll start with a whirlwind tour of global markets this Monday, setting the stage with the latest numbers from Asia Pacific, before zooming in on the major policy developments right here in the U.S. Then we'll look at some surprising turns in specific sectors like AI and energy and the ever-present geopolitical landscapes that influence it all. So what's the big picture this Monday, June 30, 2025? Our sources, particularly CNBC, show Asia-Pacific markets trading mixed. Can you give us the quick rundown on what's shaping investor sentiment across the Pacific this morning?
Yeah, absolutely. The mixed performance we're seeing in Asia-Pacific today, it really reflects investors trying to parse a complex set of data points and, ongoing trade negotiation details. A key takeaway, certainly highlighted in CNBC's reporting, is China's manufacturing activity. The official Purchasing Managers Index, the PMI, which is such a crucial indicator of economic health, it improved ever so slightly, 49.7 in June, up from 49.5 in May. However, and this is the critical point for you to remember, it still stayed below that 50-point benchmark.
So it's below 50.
Right. That marked the third consecutive month of contraction. So China's factory sector, still shrinking. And this persistent contraction is fueling widespread hopes, maybe expectations even, for more government stimulus to cushion the impact of ongoing trade disruptions with the U.S. It really underscores the fragility there.
So a tiny glimmer of improvement maybe, but still firmly in contraction territory. How did that actually play out across the individual markets then?
Precisely. And looking at the regional performance, that mixed picture becomes even clearer. We saw Hong Kong's Hang Seng Index fall 0.87%, reflecting those broader concerns around China, probably. On the flip side, Japan's Nikkei 225, kind of defying that regional sentiment, actually climbed 0.84%, hit an over 11-month high.
Wow, fifth session in a row.
Fifth consecutive session, yeah. According to CNBC, this largely stems from a weaker yen boosting exporter sentiment and some positive domestic news, too. South Korea's Kospi closed up 0.52%. Australia's S&P/ASX 200 increased by 0.33%. Meanwhile, India's Nifty 50 and BSE Sensex saw slight losses. So, yeah, really a mixed bag. And on the industrial output front, Japan's production ticked up just 0.5% in May. That was way less than the 3.5% rise economists expected, driven mainly by machinery and motor vehicles. And in South Korea, factory output declined 2.9% in May, missing expectations again following a drop in April. Retail sales were flat, too. So what this tells us, as these reports from CNBC illustrate, is that while some economies are finding a bit of momentum, the overall regional growth engine is, still facing significant headwinds.
Okay, now here's where it gets really interesting. A significant divergence. Despite that mixed bag in Asia, U.S. equity futures are actually on the rise this Monday. CNBC noted this. This follows Wall Street's surprisingly strong close last Friday. S&P 500 hitting a new record, 6,173.07. And the Nasdaq Composite also reached an all-time high. The Dow gained nearly 1%. This rally signifies quite a sharp recovery from the lows we saw back in April, when trade policy tensions were really peaking. So what's behind this resilience on Wall Street, especially when you consider the turbulence we saw earlier in the year? Is it a fundamental shift or something else maybe?
That's the critical question, isn't it? And what's particularly noteworthy here, as Bloomberg points out in some depth, is that European stocks actually outperformed their U.S. peers, and not just by a little, but the biggest margin on record in dollar terms during the first half of 2025.
Biggest margin on record.
Yeah. And the euro, it's up a substantial 13% against the dollar in the last 6 months. This isn't just a minor blip, right? This shift comes as investors globally are slowing purchases of U.S. assets. Their concern, according to Bloomberg's analysis, seems to revolve around President Trump's tariffs and tax plans, potentially impacting corporate earnings and widening U.S. deficits.
So money flowing out of the U.S. into Europe.
Increasingly, yeah. Europe, conversely, is being seen more as a beneficiary. Governments there are boosting spending. The ECB has been cutting rates aggressively, making European assets look more attractive. Analysts, as Bloomberg details, are noting this growing confidence in Europe's long-term potential, especially after Germany removed its debt brake. That's that constitutional limit on new government borrowing.
Right, the debt brake, big move.
Huge move. And they committed to massive investment in defense and infrastructure. So this suggests a more fundamental reevaluation, maybe, of where global growth and investment opportunities might be found, beyond just, a temporary flight from U.S. policy uncertainty. It's a fascinating rebalancing act we're witnessing.
Okay, so we've navigated the intricate dance of global markets and this, well, surprising European surge. But often, the real disruptive forces emerge from specific policy decisions, and that brings us right back to the U.S. Let's talk about President Trump's reciprocal tariffs, that policy where the U.S. imposes duties mirroring those placed on American goods by other nations, and the looming July 9th deadline. What are the latest developments there, according to sources like CNN and Yahoo Finance? And how are they shaping market sentiment right now?
This really highlights the direct, almost immediate impact of policy on market sentiment, doesn't it? As both CNN and Yahoo Finance reported, the July 9 deadline marks the end of President Trump's 90-day pause on these reciprocal tariffs. Now, there has been some significant movement, which, offers a glimmer of hope, maybe for de-escalation. Canada, for instance, rescinded its digital services tax on U.S. tech companies late on Sunday, just hours before it was set to start.
Just hours before. Cutting it fine.
Really fine. This, confirmed by CNBC and Yahoo Finance, was a clear move aimed at reviving stalled trade talks. And it came after Trump's earlier threat to levy new tariffs on Canadian goods, so direct cause and effect there. Separately, the U.S. and China have finalized details of a trade framework. China's agreed to resume approving export licenses for rare earth metals.
Okay, that's big. Rare earths.
Huge. And the U.S. easing some tech restrictions. That's according to CNBC reports.
That sounds like progress on multiple fronts then. What about the UK deal we've been hearing about?
Exactly. Some tangible progress, yes. It's still kind of shadowed by uncertainty. We also saw the UK-US trade deal come into effect today, June 30th. This gives a preferential 10% tariff rate for the first 100,000 British cars exported to the U.S. each year. Subsequent vehicles at 25%.
So significant reduction from the previous rates.
Oh yeah, a significant reduction from the 50% levy on cars from other partners, according to CNBC. However, negotiations are still ongoing to bring tariffs on British steel down to 0% from the current 25%. So, not fully resolved. And despite these deals, this cloud of uncertainty persists. Trump himself gave mixed signals about extending the July 9 deadline, stating very candidly, "We can do whatever we want with it." That was reported by Yahoo Finance.
We can do whatever we want. Doesn't exactly scream certainty, does it?
Not at all. And it creates this challenging, often unpredictable environment for businesses. I mean, think about the fireworks industry, for example. Yahoo Finance notes 99% of consumer fireworks and 90% of professional display fireworks in the U.S. are imported from China.
99%. Wow.
Makes them incredibly vulnerable to tariff increases.
Wow.
Makes you wonder, right, if you're a small business owner relying on imports for something like fireworks, how do you even begin to plan for next year's holiday season with that kind of tariff uncertainty hanging over you? It's tough.
Yeah, really tough. Okay, so beyond trade, there's another major policy front that could significantly reshape the economic landscape. President Trump's one big, beautiful bill, that massive tax and spending package. What's the latest with that in the Senate, and what are the broader economic implications if this bill actually passes?
This raises a profoundly important question about fiscal policy and its potential impact on the whole economy. The bill, which the CBO estimates would add over $3.9 trillion to the national debt.
$3.9 trillion.
Trillion, yeah. It managed to pass a key procedural hurdle on Saturday. It's now facing a final debate in the Senate with a strong push for passage by July 4th. That's according to Bloomberg and CNBC. The real challenge, though, and the source of significant drama, lies within the Republican Party itself. Deep internal divisions over spending cuts.
Not unified, then.
Far from it. Moderates are pushing back forcefully against cuts to Medicaid benefits, which could cause millions to lose health coverage, and also against the aggressive phase-out of renewable energy tax credits. That's outlined in Bloomberg. On the other hand, some conservatives are demanding even deeper Medicaid cuts to reduce the overall price tag.
Yeah.
It's a fundamental ideological divide playing out. And beyond the political wrangling, the economic implications are just profound. A bill this big could significantly alter inflation expectations, consumer spending, long-term interest rates, potentially reshaping the entire investment landscape for years. It's not just about what gets cut or spent, but how markets and consumers will react to such a massive fiscal injection.
Okay, so with trade and fiscal policies very much in motion, let's talk about the Federal Reserve. Bond traders seem to be betting heavily on rate cuts, almost like it's a foregone conclusion. But what are Fed officials themselves actually saying? Is there a disconnect between market hopes and central bank reality?
What's particularly striking here is exactly that disconnect you mentioned between market expectations and the official Fed commentary. Bond traders are indeed basking in gains and betting on more. The benchmark U.S. 10-year note yield hovering around 4.26%, near two-month lows as reported by Bloomberg. They're pricing in nearly a 1 in 5 chance for a July rate cut, and they see September as basically a lock for a reduction, implying a strong belief that inflation is tamed enough for the Fed to act soon.
Markets getting ahead of themselves, maybe?
It often happens because Fed officials, including Chair Jerome Powell, consistently favor waiting for more clarity on the economy. Atlanta Fed President Raphael Bostic stated on Monday, CNBC reported that the Fed is unlikely to have enough clarity on inflation and the labor market impacts to justify a July cut. He even suggested businesses anticipate the full impact of current policies stretching into 2026.
Into 2026. Wow.
Yeah, so that reminds us of previous cycles, right? Where the market's enthusiasm for rate cuts often runs ahead of the Fed's more cautious rhetoric. The key catalyst for a potential earlier move, according to Fed members, would be a material weakening of the labor market. So the June employment report due this Thursday. That's going to be absolutely critical for all market watchers.
What's the forecast looking like for that?
Bloomberg forecasts easing job growth down to about 113,000 new jobs, and the unemployment rate nudging up slightly to 4.3%. So yeah, that employment report will be absolutely crucial for maybe clarifying this disconnect.
Okay. And on a more positive note for the financial sector itself, anything there?
Absolutely. Yes, on a more reassuring note, Wall Street's biggest banks recently sailed through the Federal Reserve's annual stress test. All 22 largest U.S. banks were deemed well-positioned to withstand a severe economic downturn. That's seen as a really strong sign of their underlying health and resilience.
Good news for stability, then.
Definitely. As Reuters and Yahoo Finance detailed, this clears the path for billions in stock buybacks and dividends, providing some much-needed good news for the financial sector and its investors, signals stability in the banking system, even as other economic policies create uncertainty.
Right. Okay, let's shift our focus now from the broad macroeconomic picture to some specific sectors and geopolitical currents that are really making headlines, stuff that could define the next phase of market movements. First up, the AI and tech world. NVIDIA has been an absolute massive story, obviously, but we're seeing these intriguing reports of insider stock sales. What does that tell us? What might those closest to the company be thinking?
Yeah, this raises a very important question about market signals, doesn't it? Especially when a stock has seen such, meteoric growth. Insiders at NVIDIA, the AI chip maker that's just redefined the semiconductor landscape, they've dumped over $1 billion in stock in the last year.
$1 billion?
Over $1 billion. And what's particularly striking is that about half of those sales occurred in just the last month alone, even as the stock was hitting new highs and briefly regained its position as the most valuable company, ahead of Microsoft and Apple. That's according to CNBC. This also includes CEO Jensen Huang himself. He unloaded $15 million worth of shares recently as part of a prearranged plan. Also from CNBC's reporting. The key insight here for you maybe is that even those closest to the company might be signaling some caution, or just taking profits, suggesting the valuation could be stretched despite the overwhelming AI frenzy. It's a crucial counterpoint to the dominant narrative. Yeah.
That's a significant detail to consider amidst all the AI hype, for sure. Meanwhile, how is the AI landscape heating up over in China? And what are the global implications of that competition?
Well, while NVIDIA continues to dominate the high end, the AI landscape is indeed heating up dramatically in China, and it's leading to some very aggressive moves. Baidu, for instance, plans to make its ERNIE generative AI large language model open source, starting today, June 30th.
Open source, that's a big move.
Huge. It's being called a Molotov cocktail for the AI world by some experts, a declaration of war on pricing. That's according to CNBC. The reason for these strong metaphors is Baidu claims its ERNIE X1 model delivers performance on par with DeepSeek's R1 at only half the price.
Half the price, wow.
Yeah. So this isn't just about cost, it's a fundamental shift in strategy. OpenAI's Sam Altman has even acknowledged his company may need to figure out a different open source strategy this summer, recognizing this competitive shift. However, a crucial point highlighted by CNBC, and one that is deeply geopolitical, is the skepticism. especially at the enterprise level, regarding the security of Chinese AI models. There are significant concerns about China potentially gaining access to vast amounts of data if more products become tied to the Baidu API.
So data security is a major hurdle.
A massive one.
Yeah.
This isn't just about economic competition, it's about trust, it's about geopolitical leverage in the global AI race, with huge implications for data security and, frankly, national intelligence.
Okay. Switching gears completely now, let's talk energy and geopolitics. We're hearing about hedge funds selling energy stocks at a remarkable pace. What's driving that? And how does it tie into global tensions or maybe the easing of them?
Yeah, what's truly fascinating here is how quickly sentiment can shift with geopolitical developments. Reuters reported that hedge funds sold energy stocks last week at the fastest pace since September 2024.
Fastest pace in nearly a year.
Almost. And the second quickest clip in the last decade. This sharp sell-off aligns directly with that slump in oil prices we saw. Oil tumbled over $10 last week, following reports of a ceasefire between Israel and Iran, signaling an easing of Middle East tensions. So this swift move by hedge funds, it demonstrates a decisive reaction to perceived stabilization in a previously volatile region. They're clearly pulling back from that geopolitical risk premium that was priced into energy stocks before.
Makes sense. So where did that money go?
Well, interestingly, while aggressively selling energy, these same hedge funds, according to a Goldman Sachs note cited by Reuters, were simultaneously buying company shares in financial, tech, and industrial sectors across every global region. So it suggests a rotation toward sectors perceived as perhaps more stable or growth-oriented in a less volatile geopolitical environment.
Okay. Finally, let's talk about rare earth metals. Our sources consistently highlight China's dominant position and, frankly, the U.S.'s profound vulnerability here. What's the absolute latest in this critical supply chain battle, and why does it matter so much to you as a listener?
This truly raises such an important question about geopolitical power and critical supply chains. And it's a story with just far-reaching implications for technology, defense, even the green energy transition. CNBC analysis shows China accounts for roughly 70% of global rare earth mining, over 90% of refining capacity, and produces a staggering 92% of the world's neodymium iron boron magnets, VFANGs.
92%.
92%. And these are essential components for everything from fighter jets to electric vehicles and wind turbines. Everything. China recently imposed new export controls on 7 rare earth elements, effectively weaponizing this dependence. The critical takeaway for you is that rare earths have become a strategic weapon, giving China immense geopolitical leverage and leaving nations like the U.S. dangerously vulnerable in everything from defense to clean energy. It's a serious choke point.
So even with that recent trade framework you mentioned, where China agreed to resume export licenses, the underlying vulnerability remains. Is that the key point here?
That's exactly the point. While the new trade framework will see China resume approving export licenses for rare earths for 6 months, experts caution this doesn't fundamentally change the U.S.'s dangerous vulnerability. It's still due to that supply chain concentration. That was detailed in a recent CNBC op-ed. Concerns also exist that China's export license process itself is highly invasive, amounting to information extraction.
Information extraction, what does that mean?
It means sensitive details about a company's supply chain, its technology, maybe its client base, could be inadvertently shared, potentially giving China a competitive edge or a strategic intelligence. It's a worry. The G7 summit recently addressed this with a critical minerals action plan, aiming to mobilize capital for new projects, cooperate on recycling, try to diversify supply. But China reacted with fury, calling it protectionism. The overarching message here is that the U.S., and indeed the broader West, needs a coherent, long-term strategy to build a complete and secure supply chain, not just rely on temporary reprieves or reactive measures. This is a foundational issue for future economic and national security.
So what does this all mean for you as you try to navigate these complex markets? We've seen a Monday packed with a mixed bag of market performance, a really complex dance of policy decisions from tariffs to tax bills, cautious optimism maybe from central banks, and these critical shifts in key sectors like AI and vital commodities like rare earth.
Indeed. And while some immediate tensions appear to have eased somewhat, the underlying dynamics, trade disruptions, monetary policy uncertainty, geopolitical leverage, particularly concerning critical minerals and AI, they remain really potent forces that will continue to shape our world. Goldman Sachs, in fact, warned CNBC reported this, that the hectic first half of 2025 just heralds potentially even higher equity volatility in the second 6 months.
Higher volatility ahead, potentially. Okay.
Oh.
This all raises a compelling question for you to consider as you wrap up your Monday. As global trade negotiations continue and these domestic policy battles play out, how will the delicate balance between market confidence and these ongoing uncertainties truly shape the economic landscape, not just in the coming months, but maybe for years to come? We'll see you all tomorrow morning with new headlines from major financial magazines.